having a strong cash flow strategy, which is how you're deploying that capital, is going to be critical to success. In this episode, we explore the gritty, resourceful world of bootstrapping, where founders build startups, not with outside capital, but with hustle, heart, and whatever cash they can scrape together. Please subscribe to our podcast to stay updated. And for more information, visit our website at prospirit.com. Also, if you know someone who might enjoy our content, please share our podcast with them to help us grow.
The Let's Get Entrepreneurial podcast is your ultimate launchpad for igniting ideas and skyrocketing your entrepreneurial dreams. Your two hosts will be Professor Gary Palin and serial entrepreneur Ryan Budden.
Good morning, Professor Palin. How are you today?
Doing well. How are you doing?
I'm doing brilliantly as always. Today we've got together to discuss a topic you and I are both pretty passionate about, and that's bootstrap financing. I say we're pretty passionate about it because both of us prefer to run our startups using bootstrap financing. So we've both had a couple repetitions, or a few each, at running through with this system, and we're fans.
There's a lot of reasons to bootstrap finance. You're correct. That's my preference. And it eliminates one layer of complexities, because if you go to external funding, that makes issues that you're dealing with magnified, gives you other tasks that you have to deal with. With bootstrapping, it's your money and you're responsible for it. It puts some pressure on you, but it allows much more flexibility, in my opinion.
Before we get too into it, let's go through the what is bootstrap financing part of the episode. So bootstrap financing is when you use profits from the business to reinvest in the business, and that's how you create growth. So you're not bringing money from an outside source into the business. Therefore, you're not giving up ownership or giving up decision rights to somebody else. Does that about sum it up for you?
Yes, and also you're using your personal finances to fund the business and the seed funding component of it. And then the business then will generate the profits to sustain the business.
Right. I believe it comes from the old saying, picking yourself up by your bootstraps.
Yeah, I believe that's the origin of it. I've never looked deeply on it. I just always assumed that's what that was.
It seems like it's just become a colloquialism.
Yeah, it's part of the lexicon of entrepreneurship. I've heard it forever.
That's exactly right. It's one of the first forms of financing that I was familiar with when I was first starting my first venture, and I had no idea how to approach somebody else for money. This is where I looked first.
You maintain greater control of your business, but also down the road, you're avoiding diluting the equity.
Equity often comes along with decision-making rights, but is going to have a huge impact on the success, if you will, that you achieve when you're selling your business, because equity translates to the percentage of dollars that you're going to take out of it.
You have greater control and sometimes total control. Also, you have the ability to grow at a sustainable pace, so you don't have external funders putting pressure on you towards an exit, and that can impact your decisions negatively because of that pressure.
Oftentimes this is spoke about as a negative, but the fact is any outside source of funding comes along with their initiative. That can be a really similar initiative to you, or it can be something really different. But most of the time, when you take outside money, they have to have a plan to recoup that money. You sell the business, you bring another round of funding. There is an end goal for them. I've found in my career of consulting that sometimes the end goal for the entrepreneur is longer term, or to not sell it than the investor coming in. So you can get some friction there. And by bootstrapping, you can avoid that other person or entity's influence on what that decision comes down to.
It's very understandable from the investor's perspective on what their goals are and why they're doing this. But very often they're different than the startup entrepreneur. That can cause some potential issues that you're dealing with. There are many reasons why you would go after external funding, and we'll be doing a couple more episodes, one on angel investors and one on venture capital. But from the bootstrapping perspective, in my opinion, I like to do it if I can at all possibly drive the business through growth with my personal finances. There are times where you can't do that. You need external funding.
Or you have to have been a seasoned entrepreneur or successful in another career where you have a large sum of money that you're able from a risk tolerance perspective and monetarily able to contribute to the business.
And also with bootstrapping, I find that it encourages resourcefulness and innovative problem solving because you really are running it more lean and mean. It tends to be tighter. To be able to sustain that type of growth that you're looking for, you have to be thinking very creatively and you have to use your resources very wisely. Not that you wouldn't if it was external funding, but this seems to be tighter in a bootstrap perspective.
It's funny, when I was thinking about positives for bootstrapping, I wrote that exact same thing, but in a meaner tone, I'll say. I wrote down it forces discipline. And again, it's not because you're going to mishandle money if you're using an external source, but if it's your money, I feel like it hits closer to home. So you're really going to analyze every dollar that's spent on anything.
And there are downsides to bootstrap funding also. One is the limited resources. Also, you can have slower growth potential. So if you're in an opportunity where the window is very short, where the window opens and closes, you might not be able to achieve success before that window of opportunity closes. Also, you're risking your personal finances. There is a greater risk.
Without a doubt, you blow up a credit card or blow up a savings account, and you're going to really feel that impact.
That's something I've seen. People will bootstrap funding and they'll use their personal finances like a credit card. And I would encourage anyone listening is please don't do that. The interest rates are much, much too high to sustain that. You're putting tremendous pressure on the timeline for success just to maintain those credit card payments. That's a very dangerous game.
The way I view it is something similar in my life. I'm into racing cars. My dad told me a long time ago, if I really wanted to get into this, every car that I put on a racetrack, I had to mentally be able to light it on fire and be okay with losing it. I think about the same thing with putting money in from a bootstrapping. Every dollar that goes into it, you have to be okay with losing. Because statistically, again, we're all trying to beat the odds, but statistically, you are going to lose it.
And that has to be something mentally you have to be prepared to do that. And if you're not mentally prepared to do that, the stress and the pressure that causes on you can negatively impact the operations of the business.
When you're an entrepreneur, the line or the delineation between your business life and your personal life is a lot closer. It has knock-on effects. And if you're stressed about this from a financing perspective and a business perspective in your entrepreneurial career, that's going to boil over into your life a lot more if it's your money.
And it causes all other types of issues associated with it that just has a ripple effect of bad things happening. How about strategies for effective bootstrapping? I think that's very important to look at. My mind immediately goes to cash flow optimization, cash flow management.
That's going to be hugely important because you're playing with thinner margins. So when you get outside financing, typically that's going to be a big sum of money. So you can extend credit, if you will, a little farther. You can afford to hire somebody earlier, knowing that they're going to have a slower payback period. You can afford to get more materials if you're in a product industry. And you can do a lot less of that. You're playing with very thin margins when it's yourself. Having a strong cash flow strategy, which is how you're deploying that capital, is going to be critical to success.
It also forces you to focus very diligently. So, for example, on your marketing techniques, you have to be not just effective, but cost effective with your marketing techniques.
You can't just willy-nilly be spending money. Again, not that you're going to do this with someone else's money. You're not going to handle it improperly. But if someone's giving you $1 million, we'll say, you can afford to try 3 or 4 things if you will throw darts at a wall to see what works. When you're only playing with 10,000, you better get it on the first throw.
It also forces you to think through some very important issues that you should do with any type of business, no matter how it's funded. But you're really forced to focus on, for example, having a very strong value proposition.
The core pillar of the business. How are you providing value to your customer?
And also, you want to very much be focused on maintaining a lean operation. You don't want to be bringing in external sources, employees, with the hope that it's going to work. You want to be very focused that each operation component of the business is operating efficiently.
There are a few exceptions out there. really high specialized industries, et cetera, et cetera. The reason that's so important is because typically staffing is going to be your most expensive cost. Hiring somebody is going to be the most expensive decision you make on an early startup.
One of the areas that I look at from a broader perspective for a lean operation that includes hiring people is when I'm about to spend $1, I ask myself, is this dollar going to increase my profitable sales, or is it not going to increase my profitable sales? And if the answer is it's not going to, I'm very, very frugal, we use that word, with those expenditures, and I try to cut that down to the bone. Whereas if I'm investing and it's going to increase my profitable sales, I'm more liberal on those type of expenses.
Going along with that, when you start a business, there has to be a plan to pay yourself. When we're starting businesses, still have to live during this period. So you have draws or you pay yourself a salary, whatever you want to call it. When you're bootstrapping, there's going to be less of that, or you're going to extend that window in which you don't take a draw or don't take a salary for longer, typically.
And you're the one that's going to benefit from those lean times, those sacrifices you make if you own 100% of the equity side.
That's right. Or you're the one that's going to be negatively impacted if you reach a point where you have to take a draw, because that's $1 that you don't get to reinvest.
But one of my favorite success stories of bootstrap funding is GoPro by Nick Woodman. Do you know the story of GoPro and how he bootstrapped?
I am familiar with it, actually. Yeah.
For our audience, GoPro was funded to create affordable, robust cameras that captured action shots for surfing and other extreme sports. That was the original thought. He funded GoPro with his personal savings, and he got a small loan from his parents. What he initially did is he sold beads and shell belts from a van to fund his camera. He crafted the first GoPro and sold it at trade shows and surf shops, building a brand through word of mouth and consumer shows.
A really great example, because I think most people listening to this will be very familiar with GoPro.
If you analyze his success factors, he had product innovation, he had community engagement, and he was very adaptable. He was willing to pay the price. Like I said, selling bead and shell belts from his van, that's paying the price.
Another really great one is MailChimp. Not as big of a company as GoPro. A lot of people will probably be familiar with it. It's an emailing service. MailChimp was 100% bootstrapped, and they sold for $12 billion. So it does work. An important thing about highlighting two large companies like that is when I talk to people, often bootstrapping is thought of as a strategy for small business and slow growth. And it does not have to be that way.
Anyone listening to, I want to make it very clear that it's not solely you have to bootstrap, solely you have to do angel, solely you have to do venture capital. You can actually do all three. What that growth stage will be very dependent, one, on your goals and your strategies, but also as you're moving forward, your needs may shift. You might bootstrap initially, but then may determine, okay, I need a cash infusion to bring myself to the next level. You may look at angel investors, say, for example.
Oftentimes, I encourage people to bootstrap for as long as they can, not necessarily encouraging them for the lifetime of the business, but it's to get some sales under the belt so they can get an evaluation that's a little bit higher. So when they go to external financing, they then have a higher valuation, they're keeping more of the business, and they have proof of the pudding, if you will. It makes the conversations a lot easier.
It's also easy to get the funding. Anyone that's ever watched Shark Tank, one of the questions that's always asked is, how many sales have you made? And if the answer is none, you hear that dark music. Uh-oh. But if they have a high sale, then people are interested in. So it's not only do you get to retain a larger percentage of the business, you're able to attract investors via those sales and success factors and milestones.
Another hidden benefit to that is, as someone that has gone through external financing quite a lot, and I've partnered with external financiers to help understand tech pitches, they view very highly people that are able to bootstrap in the beginning, because it shows a certain level of stewardship for the money that they're going to be given. Don't think of this negatively, that you have to get into this VC game early on. It can actually be a benefit when you move towards that.
I was sitting through an investor pitch one day, and next to a very successful investor, and there were 4 people. 2 of them had run successful startups, and 2 were first-time entrepreneurs. And it was really interesting. The first time entrepreneurs initially were pitching and requesting nice office furniture in the captures of structuring the business. And it's important to say it didn't really matter because no one ever visited their office, but they were trying to set up a real solid looking business. The people who had been through it before, one of them said, he's going to get a big cardboard box and put down my desk in front of it until the business can buy a desk. Another one was talking about using a ping pong table for a conference room. And the investors were much more interested in the two people that were running lean and mean and operating as if it was Bootstrap, but it was with the investors' money.
And there are lots of great examples of large companies today that still operate in that mindset.
Just because it's someone else's money doesn't mean you can be flamboyant about it. That's the opposite message you want to send to an investor. So you want to have that bootstrap mentality continually as you move forward.
A good thing that our listeners could get out of this is exactly what you just said. This bootstrapping mentality can be a thing even if you aren't necessarily using bootstrapping as your financing. How can you save dollars? How can you think lean and mean even when there is quite a large cash flow?
Sam Walton famously, even after much success, drove around in an old beat-up pickup truck and brought his bag lunch to work every day.
Yeah, and Sam Walton is Walmart for anyone that doesn't know that. To this day, actually, Walmart, well, this might be a little bit old. A few years ago when I did a case study on Walmart, they, even in their C-suite, the main bulk of what was in their office other than personal effects had to be able to be purchased at a Walmart.
That's interesting. I didn't know that.
So even their very high salaried individuals couldn't go out and buy extremely lavish things to have in their office. It had to be able to be purchased at a Walmart.
Yeah, it's the bootstrap mentality.
Well, any final advice for our listeners on bootstrapping?
I would just say to evaluate if Bootstrap aligns with your personal business goals and your personal risk tolerance, and be very focused on what is the optimal measure for you. As I mentioned, we'll be publishing a couple more episodes in the near future on angel investing and VCs, so make sure to catch all 3 of those episodes, and that should help you make your decision.
Absolutely. I think that's really important to get a holistic picture of what funding strategies, especially on early growth fundraising, can look like.
And I encourage everyone to subscribe to Let's Get Entrepreneurial and visit profspirit.com for more information.
Let's get entrepreneurial.
Let's get entrepreneurial.
We extend our gratitude for your presence and attention. Check out profspirit.com to discover resources and courses designed specifically for innovators like you. Stay on the cutting edge by following us on Spotify, Apple Podcast, YouTube, and other platforms as it is released. Until then, keep the entrepreneurial flame burning.